Welcome to Knowledge Debate. My name is Tamara Slief and I'm talking today with Robert Inklaar from the University of Groningen about the role of the Fed and the European Central Bank in the financial crisis. First of all, Robert, we read the newspapers and it's full of financial crisis. Can you briefly explain what's happening at the moment?
Sure. The origin of this crisis is in the US, where a lot of mortgages were made to borrowers who are now unable to repay them. And 20, 30 years ago, that would have been a problem for a couple of banks who made those bad loans. But due to financial innovation, these banks have been able to repackage and bundle those loans and sell them to other banks or other financial players. And now that it's unclear which banks hold which mortgages, whether these are good ones or bad ones, and this has led to a big lack of trust between the banks. And as a result, normally banks freely lend and borrow from each other, but now they are hesitant to do that because they're unsure whether they will be repaid.
Okay, so there's a big problem. What's the role of the Fed in this?
Well, the role of the central bank has usually been one of a lender of last resort, the window you can go to if nobody else will borrow your money. So what the Fed, but also the European Central Bank, have been doing since the summer of '07 is to make more money available to those banks to borrow and hopefully create enough liquidity to avoid bankruptcies of big banks.
But what's the risk? Because you can't produce money without any limits.
Well, I mean, the good thing of the central banks is that in theory they can print as much money as they want to. I mean, the main risk is that this money will end up in the hands of the public, and you get, well, Germany 1930 or Zimbabwe today with hyperinflation. But at the moment, the money provided by the central banks is just a substitute to the money they were providing to each other. The banks now just hoard larger amounts of reserves. So as long as that's the case, this printing of money is not a risk for the wider economy.
So there isn't a real big problem then?
Well, there is obviously still a problem, since these banks still don't trust each other, and the long-term solution to that is to force these banks to come clean about which mortgages they hold and what the value of those mortgage packages is. Now, and that's a process that's taking time. So what this printing of money has been is merely to buy time for the banks to sort out these problems. And in that respect, the Europeans have been charting a steadier course in making a lot of money available to a wide range of players against a wide range of collateral. And as you see, especially since the start of 2008, the Fed has been adapting its approach to fit more closely to the European way of doing it. So there's more money. So
actually, the Europeans have given away to the Americans.
They've shown the way. They make a lot of money available against broad collateral, and also not just to the commercial banks who take deposits, but also to the investment banks like Bear Stearns, for instance, the bank that almost collapsed. Now, of course, the last-minute rescue probably saved the financial system from even bigger turmoil. But but it's worrisome that it came at this late a stage, and in that sense, the crisis might have come less close to a complete catastrophe if the Americans had followed the European course earlier on.
Okay, so that's actually the Americans should follow the European way. If you want to prevent an even bigger financial crisis.
Exactly.
Okay, thank you.